Hey guys, Rahul Shah here, presenting this episode on value investing, where we're trying to make investing accessible and profitable for the average investor. I hope you guys had a fantastic Diwali. I certainly did. In fact, I gifted myself something very interesting this Diwali. I gifted myself this microphone that I'm wearing on my t shirt right now. The reason being that a lot of you have suggested that I get a better quality audio input because the audio experience that they're getting for their videos is not that great, which is why I went ahead and bought this mic, and hopefully this should address the issue. This should improve the audio quality of the videos. Now, moving on to today's topic, Adani Green. A year back, I hadn't even heard of this stock, and now, as per some estimates, this company, Adani Green, has gone up so much that it's valued more than the likes of Nestle and L&T. It's bigger than most PSUs. This market cap is more than most PSUs except for maybe SBI. And it is up a huge 10 times in the last 1 year alone. This is, mind-boggling. The gains of this kind we've not seen in a while. The company, coming from nowhere and becoming one of the largest companies in the country, occupying a 17th, 18th rank in terms of market cap. So, in order to understand what the hype around the company is all around, the reason why it's commanding such a premium valuation in the market, I tried to analyze the fundamentals of the company. I tried to look at the numbers of the company, and I was surprised, to be honest. See, if you have to understand whether the company is overvalued or undervalued, you have to figure out the intrinsic value of the company. And in order to arrive at the intrinsic value of the company or have some estimate of the fair value of the company, you have to know the earning power of the company. When you look at the financials of this company, the earnings power is absent. There are only 4 years of P&L statements available for the company on the database that I normally use, and the company has made losses in all the 4 years. Yes, the company has not been able to generate even 1 rupee of profit over the last 4 years. Its balance sheet is riddled with debt. As you can see on the screen right now, the average debt to equity ratio of the company is more than 10 times, which is huge. And of course, there is no ROE to speak of. The ROE is negative because the earnings are negative. Now, I am handicapped because I cannot arrive at the intrinsic value of the company based on its earnings power of the past, the earnings power that it has generated in the past. Which is why I'll have to, arrive at the earnings power of the company based on some future estimate, make some future assumptions, and try and understand what the earnings power of the company will look like, so that I can arrive at the fair value of the company. Now, the company is valued at a market cap of around 1,80,000 crores. And if we assume that the company is going to double in market cap so that its shareholders get some kind of returns over the next 4 to 5 years, the market cap of the company will have to go up to around 3,60,000 crores. 3,60,000 crores, the company will have to increase its market cap to, if someone who's investing in the company right now has to get those 18-19% returns over the next 4 to 5 years. Now assume a decent price to earnings multiple of 20 times that will give to the company 4 or 5 years hence, which means that the company will have to generate a profit of 18,000 crores 4 to 5 years from now in order for the shareholders to make some money at the current levels. Now 18,000 crores is a huge number. Adani Green is in the business of power generation, is in the business of generating power through solar energy, through wind energy, and it will have to generate profits of 18,000 crores 4 to 5 years from now to make some kind of money for the shareholders. NTPC, the biggest power generator in the country, earns a profit of somewhere around 11,000 to 12,000 crores. Now, try and make sense of the numbers, the company will have to generate 50% more profits than what NTPC generates, India's biggest power producer generates right now, in order to make some money for the shareholder. I'm not saying that's impossible. In fact, the business model of the company is more profitable than NTPC because the company is in the business of solar power generation. It's setting up these huge solar power plants, and the margins for the solar power business are very high. They're higher as compared to your traditional power generation companies, because traditional power generation companies have fuel cost, which solar power companies don't, because their raw material is of course the energy that they get from the sun. So net profit margin wise, solar power companies, I think they generate more profits per dollar or per rupee of revenues that they earn. Even if you consider that, I don't think it's easy for the company to become 1.5 times the size of NTPC in terms of profit generation. It'll have to generate profits of 18,000 crores, which I think is very, very difficult, if not impossible. And for investors to pay the kind of multiple that they're paying for the company right now, so that the company can generate so they can see profits 3 to 4 years from now, I think it's doesn't make sense to me. The risk reward ratio of investing in the company at the current juncture, I think, is not in favor of the investor. The risk reward ratio is completely out of whack, if you ask me. And whether I would invest in the company at these levels, I don't think so I would do that. So to answer the question whether the company its valuations are in the bubble territory, I think there's a high possibility that that's indeed the case. And some disappointment on some negative news, and I think the stock price of the company can come crashing down. So investors investing in the company at the current levels, or who've invested recently, should definitely take note of that. Now moving on to the company B, the company that I have placed alongside Adani Green. I'll reveal the name of the company later, but take a look at the numbers of the company. The average EPS that the company B has generated between 2014 and 2020 is an average EPS of 16 rupees per share. The debt to equity ratio on the balance sheet is pretty reasonable. It's quite less than 1, and average ROE also, I would say, is decent, not that great, but not very bad either. So if you expect the company B to generate 16.3 rupees EPS over the next couple of years, what kind of valuation multiples would you be willing to give to the company? I think the company B is worth at least its book value, if not more, with the kind of historical numbers that it has generated in the past. And the book value of company B is 160 rupees, in the region of 150-160 rupees, and it's available in the stock market at a price of rupees 80 per share. Yes, the company is trading at a huge 100% discount to its book value, which means that the risk reward ratio of investing company B is much better than investing in company A. And if a true blue value investor was to given a choice between Adani Green and company B, I think he would prefer company B any day. Now I'm sure you would be interested in knowing which company is company B. Well, company B is the company which is responsible for 75% of India's oil and gas production. It is a Maharatna, and it is one of India's biggest companies. If you haven't guessed it by now, the company is ONGC. Yes, the PSU behemoth ONGC. ONGC is trading in the market at a 50 to 60% discount to its book value. Now, the reason being that the traditional oil and gas industry as we know it is in a decline. It's believed to be a sunset industry because the world is going green. It is assumed that a couple of decades from now, world will almost completely stop using oil and gas in order to power the economies, in order to power the factories, and the traditional sources of energy like oil and gas will be replaced by solar and wind power, which Adani Green specializes into. So Adani Green is part of the sunrise industry. That's why it's trading at such a premium valuation multiples. And ONGC is believed to be a part of sunset industry, and that's why investors are taking such a negative view of the company. Now, what typically happens in such a scenario is, people overdo the greed and fear. In such cases, people take such a optimistic view of any sunrise industry that they push valuation beyond limits. The company is trading at a starts trading at a huge premium to the intrinsic values, which I think is true in the case of Adani Green. And in the case of a declining industry, they take such a negative view of the company that the company starts trading at a huge discount to its fair value. Now, the call that you need to take here in case of ONGC is whether you believe that the company will continue to exist 3 to 4 years from now, because your investment horizon should not be more than 2 to 3 years. If you believe that the company is going to generate an EPS of 16 rupees over the next 2 to 3 years, and oil and gas industry is not going to face a very fast decline. It will face a decline, no doubt, but it's the decline is going to be slow. It's going to come in 15-20 years and not immediately. Then I think from a risk reward perspective, investing in ONGC makes a lot of sense to me as a true value investor than investing in something like Adani Green, which no doubt is a part of sunrise industry, but it's trading at a very, very premium valuations. Valuation has valuation based on earning powers, which is not there on the books right now. The earning power can come in the future, and it can come, say, 2-3 years down the line, or if something very bad happens to the company, that earnings can be delayed further. So between Adani Green and Company B, between Adani Green and ONGC, the risk reward ratio definitely seems to favor ONGC. What is your view? I'd like to love to listen to your comments on this. So please do not hesitate to post your comments in the comment section. If you like this video, please press on the like button, and please free to subscribe and share this video. It encourages us a lot. It gives us a encouragement to come out with equally good quality videos in the future as well. So that was all from my side today. I hope you like this video. See you again next time. Thank you so much and take care.